My name's Claire Keating. I'm a Trustee Director of CareSuper and State Super New South Wales, and I'll be the chair for this morning. Otherwise, perhaps I shouldn't be up here, but I will be. So, our session this morning is how long can the good times continue? For those of you with a longer attention span, the next bit of the session says, as we enter the 10th successive year of positive returns for super funds, it's worth considering the period that preceded it, the global financial crisis. If another GFC is around the corner, is there anything funds can do to prepare? And if so, at what cost to member returns? So this is, I guess, a really good continuation of the conversation that was started yesterday when we found out that we're either in for blah or bust. And if we are in for blah or bust, what strategies can funds use to prepare for that? So we have three very qualified speakers with us today, but before I introduce them, we'll go to the poll. I'm sure you're all used to this by now. So we're in Forum A, Federation Ballroom, and there is a question in there, I think. Is it coming up? How are we going for the question? Oh, we have got it. I just can't see from the light. Okay, so the question is, when do you think the good times will end? Now, there isn't actually an option for you think they've already ended, but let's just say that that's up to 6 months. And then your other options, 6 to 12, 1 to 3, or more than 3, or never. They're never going to end. So whilst you go through that, I'll introduce the speakers. So, our three speakers today. Firstly, Paul Boucher. Paul is the Chief Investment Officer from Parametric. He leads Parametric's investment, research and strategy activities, and his research interests include indexing, tax management, factors, derivative strategies and rebalancing. So, Paul will speak first. Then we'll have Sytze, Mosselaar from Robeco. Jan is a portfolio manager with the conservative equities team. And his primary responsibility is for Robeco's low volatility strategy called conservative equities. And lastly, we have Charles Wu. Charles is the Deputy Chief Investment Officer and General Manager, Defined Contribution Investments at State Super. Charles is responsible for formulating investment strategy to assist members to achieve return objectives on a risk-adjusted basis. Each will speak for around 10-15 minutes, and then we'll have time for questions at the end. So, the results of the poll, oh, here we go. So, everyone's pretty comfortable for 6 months, but after that we get a little nervous. So, we'll see whether our speakers will give us strategies around the time frames that you think you might need to work to. Okay, terrific. All right, so the AXA Investment Managers live Q&A will now be open and for the duration of the session, so please send your questions in during the session. But firstly, we'll head over to Paul.
Thank you. I'd like to share with you one of my favorite paintings. Oh, not that one. All right. This is the storm on the Sea of Galilee, and I think it's a good metaphor for our struggle against forces outside of our control. And definitely the capital markets are one of those forces. So investment professionals sometimes get a little confused about the purpose of the capital markets. They think maybe it's to provide returns to the investors. No, the purpose of the capital markets is to provide capital to business and entrepreneurs and to offload risk onto investors. So the investors definitely get risk. We also get costs, taxes, transaction costs, and so forth. So it's useful to think about the capital markets as a harsh environment. And if you go into it with that mindset, then you're more likely to be successful. So if you think, how long can the good times continue? I like that question because it's coming at it with, there's real risk out there that I should be dealing with. Not, how can I win this game or how can I be the best? It's how can I survive for the long term. So it's a little bit hard to answer the question, how long can the good times continue? You have a couple strong indicators making people a little bit worried. You have an increase in market volatility, so you saw some big daily moves in the various stock markets over the last several weeks. And also you've seen the yield curve in the fixed income markets become inverted. And that's a sign that there are many big pools of capital putting money into safer assets, causing that distortion in bond yields. So those are both fairly alarming indicators about the future. So it's not too surprising that we see people say, 6 to 12 months, a year or two, and we could see some sort of correction in the markets. But the question is that going to be a major correction, like the global financial crisis? Is it going to be just a little blip and then we're on our way to more good times? It's very difficult to tell. Another indicator that I can share with you is we've had several large investors come to Parametric asking for some sort of protection on their portfolio. So can I buy some insurance? Can I buy a put option? Can I do something to give a floor to my experience? And what we always say in this is it's very expensive to buy that insurance. So right now, if you wanted to buy a 10% floor, like I can't lose more than 10% on my equity portfolio over the next year, that costs anywhere from 4 to 5% of the portfolio. So you have to guarantee like a 4 or 5% loss right now in order to avoid a greater than 10% loss over the next year. So that's a rough kind of insurance risk premium. So it's very expensive to buy that insurance, especially when markets are volatile, and that's when you usually want it. I've only had one client come to us when markets are calm asking for insurance. And it was in January of 2007. And it was a gentleman named Duncan Smith, who was formerly the CIO of a large consulting firm. And he had retired, but he had a few clients, large multi-billion-dollar clients that he still gave advice to. And so it was a bit of a strange meeting. You got to keep in mind Duncan was about almost 80 years old. So before the meeting, we have these conference rooms with big glass walls. And he walked right into one of the walls. And so modern design can be confusing, and his eyesight wasn't great, but that's how the meeting started. And but he came to us and he said, I'd like to buy a 10% floor on my clients' portfolios. I don't know how or why, but I feel like there's too much money sloshing around in the system. And I think there's a 50% chance the market could go down by more than 25% over the next year. So it's a very specific forecast, and we kind of grilled him on it, like, okay, why do you think that? And he didn't have a lot of detailed answers. But at one point he said, I don't know, it just feels like there's a monster out there. And so we thought it was a little crazy, but the economy at the time, you think about January 2007, the economy's good, stock market volatility is single digit, the markets were up 15% over the last 6 months. There had been no daily market moves, plus or minus 1%. So the markets were calm and buoyant. There was the article about a couple hedge funds at Bear Stearns having blown up, something about mortgage-backed securities, but no one was really concerned about those stories yet. So, his foresight was incredible. His eyesight was terrible, but his foresight was incredible. In January 2000, there's no one else talking to us about risk in the market. And so we priced put options for him, and at that time, because markets were so calm, the cost was 0.5% to protect for a year. You can't lose more than 10% of your equities for a year. So he went back to his clients, came back and forth. We repriced the options in March, and unfortunately the price had gone up. It went up to 2% for that same protection, because in February 27th of that year, the markets had dropped 3.5% in a day. Like, nobody knew why. You look at the the news articles, and it's like, oh, something about China. You know, nobody knows why the market volatility was back, but it was back, and so the cost had gone up. Eventually, he convinced his clients, and they put on the protection in August of 2007 for a year. And so if you roll forward a year to August of 2008, it was incredible. The markets had dropped 25%. His put options were in the money, deep in the money, very profitable. And so his client, they lost 10% plus 2% for paying for the protection, and everyone else was down 25%. So it was an incredible trade. But now there's a conundrum. Do you put the insurance on again? Markets are even riskier now. And so the cost of putting on the protection is like almost 8 or 9% of the portfolio. So you have to like guarantee an 8 or 9% loss to protect against a larger loss. And so they thought it was too expensive. They thought the market had already crashed. And so they didn't put more protection on. And it was hard to predict at the time that things would get as dark as they did later in 2008, where the market was going up and down 10% in a single day. So the moral of the story is that protection is very difficult to buy and very expensive. So just one quick data illustration. Let's jump ahead. Oh, this is fine. So one of the things that we look at is instead of buying the insurance, what if we could sell the insurance? If it's so expensive to buy this insurance and we're long-term investors, why don't we become sellers? We'll become like an insurance company. And if we put this on thoughtfully, then we can capture a different premium. So on the left-hand side, that's the equity risk premium. So those are the equity market returns in excess of government bonds. And you can see there's definitely tends to be a positive return to equities, but then occasionally there's these big drawdowns. And then on the right-hand side, these are the premiums that you earn from selling this insurance, this tail risk. So you can sell calls to insure against large upside, and you can sell puts to insure against large downside. And so if you're a seller of that, you can collect this positive premium. In some years, the premium is larger. So for example, in 2009, just after the global financial crisis, the insurance rates are very high, and you can earn 5 or 6% on your portfolio by selling this insurance. More recent years, when the volatility was lower, the volatility risk premium was not as high, but less volatile. There's no big downdrafts, which is somewhat surprising. So what we did is we kept getting these questions, and so we worked with a large consultant, and we said, let's think outside the box. How can we answer this question for clients that they keep coming to us with? So what we did was instead of buying the protection, we became sellers. But this isn't really a new trade. So hedge funds have been doing this trade for a long time, and the problem they get is they become a little too greedy. So they gear up the portfolio, they earn these double-digit returns, and then suddenly it's like fireworks. The hedge fund blows up when there's a tail risk event. So we take a little bit more humble approach. We want to be a fully collateralized kind of approach where there's no economic leverage. So what we'll do is we take half of the equity exposure off, and we go half of the portfolio in government bonds. And then we'll sell calls over the equities and sell put options over the collateralized government obligations. And what that does is we'll earn like half of the risk premium on that side for equities, and then we'll earn that volatility risk premium. So we're taking advantage of volatility in the markets. And so that's our basic answer to how do you deal with these market forces that are outside of your control. You have to build portfolios that are somehow resilient to these shocks. And that's one of the interesting things about this. If you look at the drawdown of this strategy, if you're all equities, you lost almost 50% or just over 50% in the All Country World Index. But with part of the portfolio de-risked, you had much lower drawdown. Now, that 2008 period was painful, right? You lost money on your equities. And your options, some of those options got exercised, right? Because you sold insurance to somebody and someone collected on that insurance, like Duncan's clients collected on that insurance from you. But then, from October of 2008 to March of 2009, you made super premiums. It's like insurance was incredibly expensive and people were willing to pay for it. So you made tons and tons of money. And then March of 2009, the big market recovery. Again, you have to pay out on the call options that you wrote, but then you're earning these larger premiums. So the portfolio, the hedged portfolio, is very resilient. It has a big recovery. So whereas it took 55 months for an equity portfolio to recover, it took only 20 months for this portfolio to recover. All right. I think that's the basic idea. I'll not put you through all the legal disclosures. Okay, great. Thank you.
Thanks, Paul. All right, now we'll hear from Jan.
All right. Thanks, Paul. Starting with a Dutch painting. Really appreciate that. So I'm going to talk a little bit about low-risk investing. Are the good times over? If you think the good times are over, low-risk investing might be a good strategy within your equity portfolios. Before I do so, since I'm based in Europe, I was told to also talk a little about European pension funds. Well, I'm based in the Netherlands, and like in Australia, we have quite a well-funded pension fund system, so we're quite happy with that. And on the right-hand side, you see some of the biggest pension funds in Europe. Well, next to the Netherlands, also the Nordics, like Scandinavia, Switzerland, UK. Yeah, these are our biggest markets in Europe. And so what's keeping these funds up at night? The same things as in Australia. Costs, assets, liabilities, funding ratios, etc. And especially in Europe currently, one of the biggest headaches is, of course, negative interest rates, even swap rates becoming negative. That creates sky high liabilities, which is quite a big headache for a lot of pension funds, also causing them to de-risk their equity portfolio simply because they cannot afford to take too much risk anymore. Next to that, we've seen a massive move towards more factor-based investing, also from a cost perspective. So basically exchanging traditional active funds for more factor-based strategies that give you active returns, but against lower costs. We've seen a massive push to passive investing, simply buying the market. However, the last few years, we've seen a bit of a counter move, basically because ESG has become really important, and there has been some criticism on, if you just buy the market, you're basically too passive in terms of activism versus your companies that you invest in. So shouldn't you be more active in your dialogue with companies? So a good mix there is enhanced indexing. So basically you have cheap strategies at low costs, but at the same time you can integrate these more ESG kind of factors or elements into your investment strategies. So we've seen quite a big move towards this, so ESG related enhanced indexing. We'll talk a little bit about the low risk factor. As mentioned, there has been a lot of talk about factor investing also here in Australia. We talk a lot with clients here. And basically, if you move towards factor investing, well, the academic research looks great. So factors have outperformed over the long term. So it looks great from an academic perspective. However, there's a lot of questions and a lot of practicalities when you start moving towards these factors. Apart from all the challenges that you have, that some of these factors will underperform for a longer time period. For example, value investors currently, or if you want to exploit the value factor in developed markets, you have quite a hard time currently. And it's really important to have strong hands and stick to your long-term beliefs. But it's not always easy. And we sometimes say the bigger the miracle, the smaller the audience. Typically when When a factor does well after a period of underperformance, a lot of investors already redeemed after that period of underperformance. So we don't hear a lot of clients that say, hey, value, I really want to allocate more towards value. While it might be a good time just to do so because it has underperformed so much. So there's a lot of strong hands needed. At the same time, there's also a lot of practical questions. Which factors do you exploit? How much weight do we give to each factors? Our clients tend to like just one over n approach, so just diversify over the different factors in an equal weighted manner. It also avoids a bit of the regret that you have if you move towards factors that will underperform. Do you do it in a long short or a long only way? We prefer a long only because if you move into the short side of markets, as Cliff Esnes of AQR always says, you create LSD in your portfolios. So leverage, shorting, and derivatives. So it becomes a whole different ballgame. And your strategy changes quite a lot. So on paper, long short looks great. In practice, we prefer long only. Simply, it's much more straightforward approach. And you can also be part of the normal equity portfolio. Turnover is a thing, so how much do you time factors? Do you want to move around from time to time between different factors? Can you time them? We think it's very difficult to time these, and you have to make a strategic allocation to factors. And last but not least, ESG. Can you integrate this in the factor-based approach? Can you have a quant process and have ESG at the same time? And we think you can very well do so because it's all about data. It's about data and the right people. And using data is of course something that factor-based quant strategies do. So talk a bit, coming back to the topic of the session. Are the good times coming to an end? If you think so, if you expect lower returns and also higher market volatility. Then low risk strategies in your equity portfolio might be a good way of not selling equities because what's the alternative? Bond yields are quite low, especially when you live in Europe. So a simple way of adjusting your equity portfolio would be moving towards more low risk stocks, and we see quite a strong evidence for this factor. So what you see on the left hand side is basically around 70 years of data. US data. Very simple. Theory says if you want to have higher return in financial markets, you have to take more risks. We think that's true on an asset allocation level. So equities give you a higher returns than bonds, simply because you take on more risks. Within equity markets, within bond markets, we don't see that. We see rather flat risk-return relationships. So basically, by avoiding the more volatile part of stock markets, you don't have to give up return, and it's basically the other way around. Low risk stocks, because you lose these large drawdowns in down markets, you get to this better compounded return in the long term. And you only see that when you zoom out. So from month to month and from quarter to quarter, it can be quite a difficult strategy. Because if markets go up strongly, we typically lag. So it's basically a bit, everybody's having a party, enjoying high equity returns, and you're basically sitting in a corner of the party room writing client papers to explain why you underperformed the market. So that's not a nice feeling. When the market is down, we typically lose less, but there's no reason to cheer because we typically also have a negative return, but just a less negative return. So that's also not a great feeling. So it's a difficult strategy to persist. But we also think that makes the strategy quite successful in the longer term. But as with factor investing in general, there are a lot of concerns, a lot of things you have to think about. So I listed a few of them. The first three are more topical, come up in every client conversation that we have. First, the phrase defensive expensive comes up a lot. So if you buy these more defensive stocks, aren't they very expensive in terms of price or earnings? We agree with that a lot of defensive stocks are quite expensive. So for example, if you look at the more generic approaches like the MSCI Min Vol Index or the S&P Low Vol Index, they have a much higher valuation than the stock market, or as than the market cap index currently. So yeah, indeed, there are some concerns of overvaluation. The solution for that is just include valuation into your models. Just avoid expensive low-risk stocks. There are a lot of stocks to choose from, so why not focus on those stocks that do not have these demanding valuations? So it's a good solution, we think. Even though value hasn't worked over the last few years, but we think going forward, this factor will become relevant again. Secondly, overcrowding. So don't you all invest in the same stocks if you invest in a low risk strategy? We also share that concern. If you look at more index approaches, like for example the MSCI Mid-Vol Index, there's massive move towards these ETFs. To give an example, the US Mid-Vol ETF of iShares has doubled from 15 billion to 30 billion over the last 12 months. So it's really doubled in value. And on the right-hand side, you also see some pitfalls of these more passive, and I put passive, it's not really passive, these are active strategies, because index providers also make subjective choices when building these factor indices. And these indices, we think, have limited capacity, simply because as soon as you move away from market cap weighing, your capacity goes down drastically, simply because you're moving into stocks that are less liquid, and you can take quite a large position if these stocks are attractive toward, according to the model behind this index. And if a lot of money moves into these indices, these smaller stocks are getting bid up, so the stocks getting, or there's a danger of being overvalued. Plus, it is a public indices, so these. There's the effect of index arbitrage. We also find academic evidence for that, so we also published on that. So that's one of the concerns that we always want to point out if investors move towards a more cheaper index strategy. And that's we basically all the active factor strategy providers like Robeco, AQR, Keating, we're all basically competing with these more cheaper indices, but we always want to point out these pitfalls. If we go back to the left-hand side, interest rate risk is a concern. One solution for that is just simply mix your low-risk factors with more non-sensitive factors, for example, momentum, earnings revisions, more quality-like factors, that makes your strategy less interest rate sensitive. So there are solutions for these concerns. The last two ones, lagging in bull markets, already you gave the party metaphor, and the last one, high tracking error, that's also one that's not easy to stomach for a lot of institutional investors that have a tracking error budget. So the tracking error of these kind of strategies is easily 8%. So ironically, you have a lower absolute risk, but your relative risk can be quite high. And not every investor likes that. We think absolute risk in the end is what counts for pension funds. So we think we shouldn't worry too much about tracking error. Going to the right-hand side, going against other factors, so that's also one of the concerns. Again, that relates a bit to the overvaluation point. You can avoid that basically by taking value as an explicit factor into your models. What we like to mix low-risk factors with things like dividend yields and payout yields, so buybacks, for example. That's a really nice combination of avoiding very expensive stocks, at the same time maintaining your low-risk exposure in your portfolio. So there are a lot of ways around these concerns, but you have to think about it deeply. Then, the last point, simplicity, complexity. We think that some indices are very simplistic, and some are really complex. So really think about, is it really necessary to have, I don't know, a lot of equations into your model? We like to keep things straightforward, so we do not rely on any mathematical optimizers. We just say, okay, we have 4,000 stocks in our investment universe. We rank them from most attractive to most unattractive, based on around 30 different variables. But it's more linear programming. It's not minimum variance. So that always keeps the outcome of the model very controllable. We can always explain why we invest in a certain stock or why we have tilts towards certain countries or sectors. So our client reviews almost look like a fundamental traditional equity strategy. Then last but not least, ESG investing. Don't think I had any conversation over the last 2 years maybe where ESG was not a topic. Sometimes it's also a little, can we talk a little bit less about ESG, but I will also end this presentation with it, so I cannot avoid it. Is it possible in quant strategies? Yes, as long as you have the right data. So you have to think about having a good data provider. But it's very, in your whole creating the portfolio of factor-based strategies, it's quite easy to implement ESG from a data perspective. But you have to have the right data. On the voting and engagement, you have to have the right people, so that's completely the other side of the spectrum. You have to have the right people to engage with companies. In the Netherlands, we have pension funds that have large ESG teams themselves, so we have to come up ourselves also with good ESG solutions, and a lot of customization is necessary. So you have to be able to, different clients have different needs, and you have to be able to customize and not just say, okay, this is our standard ESG approach. That's not working these days anymore. 10 years ago that was fine, but these days we have very complicated customizations these days that our clients come up with. So that's quite important to be able to do so. That's it from my side. So I'll hand it over to Charles.
Thanks, Jan.
Yep.
Thank you. And welcome, Charles.
Hello, my name is Charles. It's a pleasure to be invited to be here to share some thoughts. Let's talk about that later. So the topic is really interesting. I mean, when does the good time end? So I was told it ended last night, 10:30, after the band stopped playing. So unfortunately, there wasn't that option. After Paul and Jan talked about conservative equities and also option writings, option strategies, I think I'm going to come from an asset owner's perspective on how we put things together. In the next few minutes, I'm going to talk about 3 things. I'm going to talk about what we are really concerned about. We're going to talk about how we build defensiveness in the portfolio, and that's that slide. I'll explain that later. And then how do we go? So inverted yield curve, recession, uncertainty, things that's been thrown around in the conference and probably in the last 5 years. In fact, I'm pretty sure there's a lot of managers told me 5 years ago that we were late cycle. 3 years, it was mid-cycle. And now we're actually closer to late, but we're still mid. So I don't know, time somehow doesn't work. So I think it's really important to ask ourselves, what are we concerned about? Because without knowing the problem, we can't create a solution. So the problem here is recession. So are we talking about a short recession, a prolonged period of recession, a deep one, a shallow one? I think most people would be concerned. Most people would be more concerned about a prolonged period of deep recession. Now, I would argue that's incorrect. Recession isn't what we're concerned about. What we're concerned is market correction. More so, we're concerned about the permanent loss of capital when market goes down and you're forced to sell. In the last 100 years, using US as an example, there were 15 recessions. Barring Great Depression, out of the 14, 7 of them, so on average, 10 months each, 7 of them market returned positively. The other 7, negatively. So you don't really lose money in recession. That is not a guarantee. Again, coming back to the question, the concern that we have is market drawdown, stay there, and then we're forced to sell. And that's the permanent loss of capital. Now, for 90% of the super funds out there, you all have positive cash flow. This is a liquidity management question. At STC, we have net cash outflow of 8% every year. we have to sell all the time. That is why building defensiveness in the portfolio is pivotal for us. And we spend a lot of time. We're on the forefront of the decumulation phase. So, how do we do it? We build defensive levers throughout the entire fund, at both the fund level and also at the asset class level. So let me explain how that works. And my apologies, there's actually a typo. So the derivative protection strategy is actually 60 basis points. But we'll come back to that. At the fund level, we do believe asset allocation drives the return. We do believe asset allocation to move away from your SAA and your DAA creates value. In the last 3 years, we added value about 40 basis points per year in both up and down market. Now, the key to a good asset allocation strategy is a robust governance framework. So I have very, very supportive directors. It is about the flexibility. We have quite a good, robust, comprehensive delegation framework that allows us to move when we have to. And last but not least is the implementation. Implementation efficiency, critical. As much as I love, investment bankers, they're all nice people. Buying an OTC option from them, the price difference between different banks can be 2% wide. While we're talking about basis points of management fees, implementation is something that most of us did not pay enough attention to. We do believe investing in a diversified portfolio can mitigate the drawdown, and that's actually 40 basis points. Derivatives, yes, we do use derivatives. Our mission is to ensure that member has a smoother journey when they're with us. So we tend to purchase the 10% out of money put option. 10% out of money put option. Now, one of the key learning for us is, let's say if you have 50% as your neutral equity position, you spend 50 basis points in buying put option. Your expected return for your equity asset class is 10%. You need to increase your equity by 5% in order to compensate on the cost that you pay to buy the option. If you simply just buy put option, yes, that's a loss-making strategy. No one should do that. Now the question is, why would you do that? Yes, in an uncertain world, you still want to participate the upside, but you protect your portfolio on the downside. That's why we increase the equity and we buy put option. At the asset class level, on the liquid growth, so similar to what Jan and Paul was talking about, we do have option writing strategy that tend to write 1 to 3 month tenure strike, 108, 110, so 108, 110 call options. Those provides really, really good income. They expect the income to come in from that strategy is about 3%. We do have defensive strategy that has delivered really good outperformance in the last 5 years also. The way to read this table is we have a framework, we have SAA is our starting point. So everything that I try to put on this report is the value add when the market goes down by 10%. So if we focus just on the liquid growth, what that means is when the market goes down by 10%, I expect my equity portfolio to go down by 8.4%. That's a 1.6% saving. Equity is roughly about 50% of the total portfolio. That then translates into 81 basis points. And that applies to your property, infrastructure, liquid defensive, which is bonds, and alternatives. I left currency in red. We're doing a lot of work on currency at the moment. So there is a common belief that currency will come in and save the day when there's a down market. Well, it didn't. Not Q4 last year. It worked very well in August, but not last year. And we believe that that is one of the key risks that we're facing. As we headed into this uncharted territory, that the behavior and the characteristics of asset classes, the correlation, the relationship, they're changing. So Aussie dollar may not come and save the day. And if that's the case, how do we do it? That then comes back to defensive equity, a very diversified defensive levers in the portfolio. We have, again, going back, we have the defensive equities or conservative equities, and then we also have options. Option is a contractual agreement. will definitely pay off, right? But it's costly. So I hope that gives you a bit of color about the defensiveness that we're building into different parts of the portfolios and how that helps. So the next question is then very important. How do we go? We put things in place by design. We need to know whether it works or not. So the quickest way to read this is Q4 last year. So the quickest way to read this is to read the two most right-hand side columns, the D and the E. So, sorry, I need to flip back a little bit. So if you look at E, 0.8 is the expected value add for a 10% drawdown. That coincides with the 80 basis points, so 0.8%. How did we go? We added 90 basis points. So our equity portfolio actually delivered in the down market much better than we expected. Multi-asset, we expected our multi-asset portfolio to add 50 basis points in the down market. They added 30 basis points, not good enough. And that's what triggers the sector review. Liquid defensive, we expect 80 basis points, they added 1%, very good. So this is how we, again, coming back to this, like, I hope that gives you some ideas in terms of framing the right question, then we can create the solution. We put defensiveness not blindly. Though it's trade-off, it's all relative, it's decision. And when you make that decision, it's quite important that we measure it and then we come back to it. So that's how we do it at CareSuper. So I think that's it for me. Thank you.
Thanks, Charles. So now we'll open it up for questions. There are a few questions that have come through the app, but also feel free to use the old-fashioned way. There'll be microphones around the room. But I'll start with one of the questions that's provided, and Keith Harvey will be very happy because he said that I said if he had a good question I would give him prominence. So Keith's question is, are the factors that cause the GFC present again now, or are we in a new paradigm? Who wants to take that?
Yeah, I think it definitely, from my perspective, it's a new paradigm. I don't see the same, levels of gearing or leverage that we had in 2007. I think one of the things that I like to do is look for, like, what is strange right now? What is unusual right now? I think, inverted yield curve is strange. Negative interest rates are very strange. Tariffs are very strange. We haven't had tariffs like this for, 75 years or more. But I don't see the strange things that we saw in the GFC. So whatever happens in the future, it's going to be different than the past.
Yeah.
Yeah, and most of those things are related to central bank policy. I think what we've seen over the last 10 years, basically not blowing up, but increasing the balance sheets of the central banks. That has been, unprecedented. That has never happened in history. So I think that's really strange. But we don't think this will lead to a new financial crisis. Indeed, the banking system is much more conservative than it used to be. In the 60s, 70s, banks were almost like utility stocks. We're going a little bit that way again, that banks are having very high capital ratios. So we don't expect any financial crisis in the banking sector there. We do, however, expect lower equity returns, so below average, mainly because valuations are a bit higher. And also higher market volatility, but that's not a very controversial statement because I think that's what everybody expecting. And if you look at volatility in the last few years, has been very, very low. If you look at 2017 Q4, at a certain point the MSCI World had a realized volatility of 5%, which is also unprecedented, and it's typically associated with bond markets volatility. So that was also strange indeed. But I think now it's getting a bit normalized again with good months and bad months alternating.
Anything extra, Charles?
Yeah, I guess for me it's the negative interest rate. It changes the asset behavior, it changes the correlation. A lot of the conventional, I guess, wisdom, things that we learn just doesn't apply in this world so far. The very foundation of the entire finance is time value of money. And now in the negative interest rate world, that's been changed. So I think we'll start to see how that fits into the asset classes. Most people still don't understand, me included. I think that's what happened.
That actually brings us on to a question around negative interest rates, and interested to hear from all of you in terms of the strategies. How will they operate in a negative interest rate world? So perhaps, Paul, if we start with...
Yeah, I mean, I think it's interesting. I view it as a flight to quality, and it's going to be, I think, it should be a fairly temporary effect, although you never know going into these things. I think if you look at, just generally making equity asset classes and, dividends more attractive generally than looking at fixed interest. So.
Yeah, you've seen an impact indeed on a lot of stocks that have become quite expensive because of their bond-like characteristics. So yeah, definitely be aware of that and be careful with that. As mentioned, you can't just avoid those expensive low-risk stocks quite easily if you take valuation into account. But that's it's something that it's quite logical what happens when interest rates are zero. And then, of course, another part of the market that profits from this is property. So there's almost no alternative for bonds. And property is, of course, also next to equities, one of the main beneficiaries. So I think low-risk stocks do well when interest rates are declining or very low. That creates the danger of overvaluation. So be aware of that.
So I think the thing about negative interest rate at the moment, or maybe let me take a step back. I think it is human behavior that when we operate in an uncertain environment, which we are in now, we started very slow. We go back to the foundation and start with what we believe in. Buying the defensive stocks, buying option, which is contractual agreements, we also kind of see a bit of that happening in the growth stock. So we start to tend to focus on the equity that has a cash flow further down the track rather than upfront. That's a natural behavior when time value of money doesn't work. Right? We will start to see how infrastructure, how property respond to a negative interest rate environment. Valuation cannot just be re-rated continuously higher and higher, but at some stage, the denominator is going to get so small, and then the negative interest rate will fit into the numerator, and we start to see how that gets reflected in the future growth.
Thank you. Are there any questions from the floor? Is there one? Oh, yes, here we go.
Good morning, everyone. It's a good effort for everyone to be here on Thursday morning. Dan Birch from Perennial. Charles, you touched on foreign exchange as potential defensiveness. I'm just wondering if you can expand on that, and if the rest of the panel could add a little bit more with regards to FX.
Yeah, so I think there is a common belief that when you invest offshores, SSD denominators in, say, US dollars or foreign currency, Australian dollar is a growth currency, high beta currency, so when the market does go down, Aussie dollar tend to go down. So the value in foreign, the dollar value of your foreign assets will not go down as much. So that is a general belief, and I do believe in that. And there is, again, common belief that Japanese yen and US dollars tend to be the safe haven currency. Empirical study has shown that in almost every down scenarios, US dollar and Japanese yen has performed really, really well. I'm not trying to say those don't work anymore, but again, coming back to Aussie dollar going from a carry currency, high interest rate currency into now that US dollar is actually having a positive interest rate differential. Naturally, you'll think that should change the characteristic of the asset classes. So we're doing a lot more work to ensure that, I guess, the robustness of using currency as a defensive lever.
Yeah, not much to add to that. Only what I would like to emphasize is indeed Australian dollar has a positive correlation with equity markets in the long term. So it's really a risk-on currency. But if you look back over the last 5 years, this hasn't been the case. And I think the hidden variable there is the poor performance of a lot of commodities. So even though equity markets went up a lot, the Australian dollar didn't go up a lot. So the positive correlation is not a given, and you cannot rely blindly on that, I'd say.
Yeah, I think there's a lot of, there's a lot of things you can do in the short term to think about currencies. You can use factors. You can think about the carry or the valuation or the momentum of those currencies and try to create short-term predictions. But if you think like long-term, should I hedge currencies or not hedge currencies? Is that a risk I'd like to take? It's hard to find good economic arguments that having currency exposure creates a long-term expected positive return. So we know it's risky, so you get risk and you're not expecting a long-term return. It doesn't seem like a great asset, even if it has low correlation to their assets. So, long term, I think there's a strong theoretical argument for hedging currencies. And then you just have to marry that with what are your short-term views about, as an Australian investor, what do I think about the Australian dollar and so forth. But yeah, long term, hard to think about why you would not hedge currency.
Okay, I think we've got time for one more question.
Thank you very much. It's Brendan Casey from REST, and thanks to the panel for taking on a very difficult question, because obviously it's talking about what happens in the future. And future data isn't readily available at the moment, so we tend to look back in the past and use that data. So my question for the panel is, what time in history do you think is most like where we are today, that we can, and we've all said it's quite different today, but what time in history is most like where we are today, and then what can we learn from what happened?
Yeah, I think that we've had maybe an almost unprecedented long bull market. So you think back maybe like the 80s or late, the 90s. I don't know. All right. I try not to do. I'm a quant, so I do a lot of back testing. But I was born in 1971, so I'd like to not do any back test before 1971 because I know nothing about that. They're totally different economics and different things going on. So you might have to go back very far indeed to find a situation like we're in right now, given the length of the positive returns. You think about, okay, let's talk to a staff member. Here's an experienced person. They have 10 years experience. They have a CFA, an MBA. They're super wise, and yet they've never experienced a serious drawdown in the markets, right? And I remember the same character, Duncan, when he was CIO. It was in 2000 when they had the tech crash. He gave a big speech to all the investment analysts, and he said, "Okay, I lived through this in the 70s. Now's the time when you hide under your desk, and it's going to last 8 years." And we're like, "Oh, this is terrible." But fortunately, recovery was quick. But anyway, I think that living through these experiences is good professional experience. But now you have a whole class of investment professionals who haven't experienced it. So,
excellent question. I actually wrote a small book on financial history, and so I invite you to also look at that for parallel time periods.
what's the title?
Financial History of Europe.
Oh, nice.
It's a Robeco publication. It's not a commercial book. I think after the Great Depression in the 1930s, you also saw, for example, if I speak in my own expertise, low-risk stocks, that a lot of defensive stocks became more expensive. So that's also currently a little bit the case when you look at the more generic approaches. And I think that's parallel to the late 30s and 40s.
I can assure you that was a really good read. Yes. My answer will be it's again, negative interest rates, inflation's muted, the amount of money that's been pumping into the system, I don't think there is, at least based on the record that we have, like equity number going back to 1900-ish, I don't think there's any overlapping history that we can test on. That's my view.
Okay, well, that's all we have time for this morning. Can I remind delegates to rate this session and provide any feedback on the app? I think we've covered a lot of ground. We started with Dutch paintings, we heard about LSD and portfolios, and we ended with book recommendations. So covered a lot of ground. So can you please join me in thanking the speakers, Paul, Jan and Charles.